All right, welcome everyone to this evening's webinar titled Trading in the New Economy, and we're going to be focusing in on average trading ranges. My name is Brian. I'll mention this a few times that I would like to hear your feedback, or if you have a question on something or would like to look at a foreign currency pair or a stock or a ETF or something like that, please go ahead and type in your information. You can go ahead and use the question button there. You can even use the chat function. So I'll make sure I say it a few times as people come in a few minutes late, which is just fine, but I just want to make sure that I'm answering your questions as we go along. So I'll be kind of pause here and there to check back and forth as I'm on slides, going back and forth to seeing if you do have questions. There you have, again, my name and the name of my company, Jupiter Peak Financial, which is a boutique trading and investing consulting company where I break down who that individual is, learning about their needs, their goals, things like that, and then focusing on what they can achieve given their account sizes, risk tolerances, and time available to the markets. You have my email there. You can contact me with any questions, and then you also have my blog there at the bottom where I try and update most every day on market action. So we haven't spoken in a couple weeks as far as the webinar goes. So before we get into things, let's get the logistics out of the way and go through this disclaimer. I'll leave this here for a few seconds. And this disclaimer is very, very important because as you're trading and investing and using leverage, you obviously want to have trading plans. You know how deadly it can be to let a trade run against you and see what it can do to your account size. So as most of the people that work with me know, then that I'm always hammering them on what was their trading plan, why did they get into that trade, what were they using for the story, how are they risking their money basically based on their account size, based on the trade and the strategy for that trade. So you've got to have that all thought out before you get in. So that's very, very important. All right, the outline tonight, let's do a 2-week catch-up on the fundamental analysis that's out there. We'll go into technical analysis, looking at major trends, some support, some resistance, and obviously current market examples. And then we'll start to move into the main subject tonight, which is average trading range, and relating that to the VIX, basically the volatility index. All right, so let's discuss the current events and what's going on out there. Not much has changed for the most part since you and I last were here 2 weeks ago. We got through earnings okay for equities. We've had, the international flare-ups here and there. Nothing that is obviously, nothing that we're not used to and that we can't get over. The stock market is still relatively close to its highs. We've had some talk about currencies and interest rates overseas in the United States, but for the most part, everything's kind of been status quo. We'll look at the euro and see that they did change their expectations about inflation versus not raising rates and things like that. So that did affect the euro drastically, and we'll talk about that and see that. But for the most part, things have stayed pretty much the same for the past couple of weeks. As far as the economic calendar goes, you can get that by going into the Interbank FX website and then going onto their tools and then under their online tools and into the economic calendar. You see there I have it bulleted right in the middle of the page there. I already have it loaded up, so where you would be landing if you did click on this economic calendar is forexfactory.com. So let's go ahead and go to that page quickly. Again, this is a free site. It's linked right through Interbank FX, but it's very, very, very important to be staying on top of as far as understanding what's going on fundamentally out there. It gives you different economic events for every single currency pair basically out there that you're trading. I mostly focus on a US dollar denominated pair. I live here in the United States. It's very easy for me to understand what's going on here, so I don't have to look at two currencies that I'm not really associated with or understanding, so I only have to deal with one and then relate that to the United States where I live and the economic policy and the economy here. So Monday we didn't have any data in the United States. Tuesday we had a little bit of data, nothing too important or shocking, new home sales. And Wednesday Today we did have durable goods orders, which definitely came in much less than expected. The stock market was having a very, very good day today, and then it kind of backed off at the end of the day. But as we've been talking about, the elephant in the room is the Federal Reserve. They're still in play, and they can still do more to help out and benefit our economy with interest rates and keeping them low and things like that. So that's what you have to understand is you have to understand fundamentals because you have to understand the driving force out there. And right now, the economic calendar isn't taking the front seat. It's taking the back seat. And so sometimes good news is good for the market. Sometimes bad news is good for the markets. Every day is different. And that's the whole point of titling these webinar series is back to basics. All of these relationships out there that you're used to understanding, they may be breaking down. They may be coming in and you may be able to use them. They may be breaking down. They may be coming back in. The point is you have to have a trading plan for the foreign currency pair that you're trading, for whatever financial market that you're trading, whether it be equities, whether it be futures, whether it be commodities. And so that's where that whole disclaimer comes in that you must have a trading plan. So remember, there's no guarantees out there. No matter what you know, no matter how much work you put in, things can change in the blink of an eye. And so past performance is not a guarantee of future performance. Anything can happen. That's why you must trade the right size given your account and your risk tolerances and how much time you can devote to the markets. If you don't understand how to figure that out, that's two major terms I use all the time, account risk and trade risk. You've got to know what those are. So core durable goods today came in a little bit below, but the markets loved it. Hey, that's great. Let's go up 70 points today. Tomorrow we get a number that is fairly important, again, fairly important, quote unquote, knowing what's going on in the background. We do have GDP, preliminary GDP. We also have unemployment claims. This is a biggie, guys. I'm going to look ahead here. Unemployment claims comes out every single Thursday, every Thursday morning before the markets open. The markets open at 9:30 Eastern. We get this at 8:30 Eastern, and it's been climbing up. The number of people asking for the number of people asking for unemployment claims has been going up. So I'm just trying to check back here and look for questions as well, just making sure that there isn't. So that's why I was just pausing there. All right, perfect. Let's just pause here and get this question. Are there still strategies available for trading AXP since it has broken out of its channel? Yeah, we'll get into that. That's a specific one. We're dealing with average trading ranges today, so we'll talk about that and look at that. I may not get to it exactly, but whoever was asking that question on AXP, please go ahead and email me that just so I remember if I don't get to it tonight. All right. So no, thank you for answering. That's exactly the questions that I want. I may answer them if they're on the topic. I may kind of hold them off, but that's exactly what I want from you guys. So let me get back into the unemployment claims talk. So the unemployment claims every week has been going up. It's been averaging in the high 300s, 380, something like that, and then it really spiked and kind of started averaging closer to 400, even above 400. So that 400 number right there is pretty consistent with zero to very little job growth. So it's May. We had a lot of people maybe graduate college looking for jobs, things like that. So I'm really, really interested in seeing next week's unemployment report. So the first Friday of every month is the big government jobs report. So we'll skip ahead to that in just a second. Friday, so Thursday we know we have unemployment claims and GDP. Friday, not too much going on in the United States, but let's fast forward to next week and things definitely pick up. So the economic data calendar has been light the past couple weeks. That's why I said nothing shocking out there, still knowing that the Federal Reserve is in charge. And then we get to next week. So let's go through next week very quickly. So this is what traders are always trying to do. Where are the markets going? So they're always looking ahead. Obviously, we have a shortened week. Monday with the holiday for the United States. Tuesday, as I scroll down, we have consumer confidence. We have purchasing managers index in the Chicago region. which also gives us an employment component to that. So that's nice to see as we get some pre-employment data when we get some of that manufacturing data. Wednesday, we get manufacturing purchasing managers, not for Chicago, but for the entire United States, again with an employment component. Here you have ADP non-farm employment change, not a government number, it's a private company. So you have to kind of take that for what it's worth. That's definitely not going to trump by any means Friday's number. So I would almost put more weighting on how we're doing in the manufacturing sector than a private company here, but you never know. And then on Thursday, boom, your unemployment claims, which I said have come every single Thursday. And then finally we get into Friday, we get our non-farm employment change. They haven't even given us an estimate of where they think it will come in. I'm thinking it might back off a little bit, knowing that those claims have been a little bit higher. So we've been doing really well. We've been coming in above expectations as far as recent employment reports. Will that maybe change? So that's what you got to have to think about the markets. Are they setting up and trying to position themselves over the next 3-4 trading days as we get closer and closer to that next Friday? You as an investor, you as owning stock portfolios and 401ks and IRAs, what do you need to do? Is there a relationship that you can use to trade foreign currencies to protect your assets? Is there a relationship where you can use to understand using puts, using bearish strategies? You might want to take defense out. So that's what I kind of work on with individuals depending on what they have available to them. Hey, you're at risk. You have this, this, and this, and it's all long in the markets. It's in mutual funds. It's in IRAs. It's in stocks. And if the markets go down, your net worth goes down. So that's what you have to think is, how can I use the markets and these intermarket relationships that I talk about, that I did a webinar on 2 weeks ago. How can I use those to start to buffer my losses in case the markets do take a hit, in case unemployment climbs, in case the Federal Reserve doesn't help us out with QE3, QE4. So you're always looking ahead. Some people are looking ahead for the next few minutes if they're a day trader. Some people are looking ahead for the next few minutes if they're a day trader and looking further down the road, depending on how much they have at risk in the market. So every single person is different. That's why when I teach individuals, I like to do these webinars and blogs and things like that. That's mass, for the masses. But when I work with someone one-on-one, that's where we really get to know what they are, what they have available to them. And that's the only way that I could teach individuals, is individually, basically, because everybody is so different. All right. So we're leaving the fundamental calendar. Like I said, you guys kind of get the routine here. We'll always cover that first. Ways to pair that, any of the data that we just saw as far as United States data, that's for sure, and some international data, will always be on CNBC. So you don't have to stare at the computer. Hey, I do my homework on Wednesday night. I know what's coming out tomorrow. I have at 8:30 a.m. initial claims. I turn on CNBC, and they're going to be able to tell me what's going on. So I don't have to sit there and hit refresh or anything like that. So make sure you time everything that you're looking for to come out, time it with the TV, and just let the TV tell you, and then you can decipher what does that mean for you as a trader, what does that mean for you as an investor. You also have Bloomberg, which is a TV station, and it also streams over the internet, and then Bloomberg.com, great site for headlines concerning big topics out there, gold, the dollar, interest rate policies, things like that. Obviously, the wonderful education coming from your broker, whether it be Interbank FX, or whether it be the other broker that I'm using here, the charts as far as the equities go and options go, called Options Express. And then you have a plethora of other market sites, but just make sure you cut out a lot of the data out there and make sure you start to focus and hone in and filter that data for who you are as a trader. All right. Again, I'm just checking back for questions. So as people start to come in the room, please use that question function or the chat function to ask questions. We already had one come in about American Express. We may bring that in, but again, like I said, I may hold off on some of these questions. I may ask you to email me if they're not really on the topic. So we're getting into the fundamental analysis. We're about to leave that, and we're going to move into technical analysis and then move right into the main topic for tonight, which is average trading ranges. But please go ahead and use the questions function or the chat function to ask questions, and I will check in there. All right. Moving into technical analysis, what are the traders doing with all the fundamental news that we're paying attention to? What are major trends out there? What's major support, major resistance lines that we can start to use to make lower risk, higher probability trades, again with a trading plan, because there is no guarantee out there. Just because we saw support previously doesn't mean it has to be support in the future. And let's go look at some live market examples with intermarket relationships. So I talked about one major news event that happened since we spoke last, and that was the euro-US dollar. They were expecting over in the euro a week and a half ago or so for the European Central Bank, basically the European side of the Federal Reserve here in America, they were expecting them to be hawkish, and hawkish means we are worried about inflation. So think of hawks as flying downwards, all right? So we're going to be bearish the markets by raising interest rates, and that's bad for the markets because companies have to go borrow money at higher rates. If you hear the term dovish, think of a dove. When you let go of a dove, it flies up. It's bullish for the markets, so we're going to lower interest rates. We're going to have an accommodative policy. We don't care about inflation. We're basically going to cause inflation. So right now, you could say that the Federal Reserve in the United States has a very dovish approach. They are saying, we don't see inflation out there. We're keeping rates low for an extended period of time, and that's buoyed the stock market greatly. Well, let's look at a daily chart here of the euro. This huge area right here is when that announcement came out, and the European Central Bank was expected to be hawkish, and they said, nope, we don't see any inflation out there, just like America. The gas you're paying for, the commodities you're paying for, the milk you're buying at the grocery store, it is not more expensive. There is no inflation out there, and the traders were expecting them to say that they saw inflation, which they said they didn't see inflation, and the euro went from 1.48, let's just round it to 1.49, within a few days to 1.43, let's just say. So it lost about 6 pennies. Pretty big move in 2 days. Very, very big move. So that's where you have to understand the fundamental drivers driving that. That day wasn't a day to be buying the euro. All right, it was a day to be selling the euro, and then it carried through. And then, as you can see, weeks later, it's continued to carry through. Basically, a month later, where we lost another 3 or 4 pennies. And we're down about 140 or so and kind of hanging on those lows. So that was a fundamental event that drove that, and now it got the markets very, very excited. And here's really, really clearly we can start to see average trading ranges, okay, because we're on a daily chart. So I'm going to move up here on the upper left and put my crosshairs on here. All right, so this is a daily chart, so every single bar here you see is 1 day. And before I jump into this, again, let me just check back and see if we have any questions. Would this webinar be recorded? Yes, this webinar is going to be recorded. It does have to go through compliance, and then basically it will be posted on the YouTube site, and I'll give that site at the end of the webinar. But yes, if you Google or go to YouTube and search Interbank FX, these videos will come up, and then you can just basically search for Back to Basics, because that's the title of it, or Average Trading Ranges. But yes, sir, all of these webinars are recorded. This is my 5th webinar. I do them every 2 weeks on Wednesday night at 9 Eastern. This is my 5th webinar with Interbank FX. The next webinar, 2 weeks from tonight, will be on placing trades using their contingent order, where you're basically placing a pending order to be filled, and then if that's filled, using stop losses and take profits. So I'm kind of going through every 2 weeks and building on certain subjects, but yes, you will be able to find them recorded. And then, like I said, to stay in touch every couple of days, you'll be able to read my blog as I update it, and that address is also on here. So thank you for typing that in. Like I said, guys, please use, and girls, please use that chat or question function so that I can make sure I answer that. All right, let's get back into the markets here. So average trading ranges, all right? Look at the size of these bars. Right here, let's just start in January of 2011, okay? And the euro is going up and up and up, has a little hiccup, and up and up and up and up. And on average, these bars, we can start to measure them. So I'll just pick one right here. The high price of this bar is 38.22. The low price of this bar is 37.03, 120 pips. The next bar next to it, the high price 38.37, the low 37.23. A little bit over 100 pips. And I'm looking at the high, open, high, and low. You'll see it pop up right down here. And so basically we can kind of just eyeball it and say, yeah, the average has been about 100, 150 pips, something like that, as the euro has been going up and up and up. And that was basically January of this year, let's say all the way through almost to the end of April. Just quickly, let's see what the stock market was doing during that same period of time. Okay, so we're going to jump into, like I said, Options Express to look at our equity charts. And here is January, beginning of January, and then we went up and up and up and up and up, had a little bit of hiccup. We know that that was basically Japan, and up and up and up and up, had a little hiccup, and up and up and up and up. So basically we've been going up to sideways. We definitely haven't been crashing by any means, and then we've kind of started to go a little bit down over here. But for the most part, things have been pretty good. We're the highest point we hit in the S&P was 136, basically relating to 1360, because SPY is 10% of the value of the S&P 500 that you hear every day on CNBC in the news. So 1370, let's say, was the high. We closed today at 1320, 132 to 137. So we're 50 points from our high. That's in striking distance. We could do 20 or 30 points in the S&P to the upside in a couple of days. We've seen it happen. So we're definitely in striking distance. So overall, the stock market's been taking Japan, taking Egypt, taking Libya, taking Greece fears, taking Strauss-Kahn over, and by the way, I'm not related to Strauss-Kahn in any way. I was just in New York actually this weekend checking into a hotel. Felt very strange, but no, there is no relation to Strauss-Kahn. But basically, the market is taking all of this in stride and really, really hanging in there. And so I told you I was going to introduce you to the VIX. And so a lot of foreign currency traders may not pay attention to this a lot, but option traders definitely do, because this is their life basically. As the more volatility out there, the more that they can get for selling options, and the more likely options are going to move, so they can buy options. It might be a little bit more expensive, but there's going to be more movement priced in. So the VIX is a fear gauge or uncertainty gauge. So as the stock market goes up, 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 the fear gauge goes down, 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 down. Hey, everything's great out there. Hey, there is no inflation out there. Hey, there is no unemployment out there. Stock market 10,000, 11,000, 12,000, 12,800. The VIX goes down and down and down, has its spike because of Japan, and then goes down, 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 and makes new lows. Let me get this on a longer-term chart so you can see it. Here's a one-year chart. That is a downtrend, folks. The VIX is going down, 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 down. And it peaked up here a little bit, but it makes sense if you look at the stock market. The stock market's been rolling down as of late over the past few weeks. The VIX is going up as of late over the past few weeks. So as we get more volatile and the VIX starts to pick up, and trust me, folks, the VIX is still very, very, very low. The stock markets are very, very high. The stock market, VIX, and foreign currencies in any market you're trading out there can get way more volatile, and that's why you have to have trading plans, because there are no guarantees as far as what's going to happen tomorrow or the next day or the next day, or for some of you Forex traders, the next minute to minute if you're trading intraday, and you know how fast things can change. So you must have trading plans, because there are no guarantees out there. So things can get a lot more volatile. They're getting a little more volatile than where they were the past few weeks, because we're higher in the VIX, pushing up towards 20 level instead of down around 14 or 15. Percentage-wise, that's big. If you go from 15 to 20, $5 of a $15 entity, quite a big move, 30% move basically. So very, very, not a sharp rise, obviously, in volatility. You have a sharp rise in volatility when you have an event like Japan or something like that that's totally unfounded, basically. So this, like I said, things can get a lot higher. It just depends on what's there to drive it. But the point is, things have gotten more volatile, and the stock market, as you know, is having more swings. We'll look at yesterday's action where the stock market was up and down and up and down, and we'll look at see the currencies, how they were relating to that. Let me just check quickly for questions here. Okay. Looks like we're good. All right. So getting back into the euro. So we have this, as we were talking about, these average days were 100, 150 pips or something like that. Well, let's look at this day. Then we have a big news announcement that wasn't supposed to happen the way it came out, basically. And the high price here is 1.4898. I'll round that to 1.49. And the low price is 1.45. So that's only 400 pips. Only 400 pips in one day. And then the next day, roughly about 300 pips. And then we consolidated a little bit. But overall, these bars you can see are getting bigger than these bars as volatility, as more uncertainty, as more fear, as more anxiety creeps in. And that's good for us as traders. We want movement to happen. Maybe it's bad for you if you're an investor and you have long-only mutual funds and stocks and things like that, but that's where you have to say how much is out there, how old am I getting close to selling a business, am I getting close to retirement, am I getting close to relying on Social Security, can I start to generate income by using options on my stock holdings? Can I start to generate income by doing bearish and bullish income strategies on the stock market using option strategies if I'm knowledgeable about that? That's basically what a hedge fund does. That's what I do with Jupiter Peak Financials. Find out what is a person of what availability does of a person have depending on what they're holding and things like that and account sizes. And hey, let's go make some money. Let's go make some money right now. Let's not worry about 20 or 30 years from now. Let's go make money every day, every week, every month, depending on their situation, and link these markets together. So you have the euro getting a lot more volatile and providing some intermarket opportunities, and you have the stock market, as we saw with the VIX, getting a little bit more volatile. So overall, the average trading range in the Forex markets has increased. The average trading range in the stock market has increased, and I'll show that to you on that daily chart here. So this is a 1-year chart of SPY. Let's go ahead and type it in here. Okay, and so it's pretty hard to tell here, but these moves are bigger, and it's hard to see because they're bigger intraday, meaning they're having more swings. Today was kind of a good example of a trading day that we've had for many, many months as the stock market would go up. You can see just up and up and up and up every day. Very, very, very few red bars, and if we had red bars, they were very, very small. So the markets would just open up, and they would go from 0 to up 50 or up 30, and then they would just be done for the day and go sideways, and then they would close. And then the next day, up 20, really quickly, and then go sideways. So you weren't getting multiple opportunities per day. But what's happening now here, if I shrink this down and we get a little bit more data, again, you won't see it because this is still a daily chart, but what you're going to have is you're going to start to have intraday moves, up, down, up, down. So we might only finish up 50 points or down 50 points, but within the day, we're up 50, down 50, up 50, down 50 multiple times, which gives us overbought, oversold, overbought, oversold. And if you realize that and understand the relationship between how the dollar is reacting to equity movement prices, well, then you start to have good trading opportunities on your hands that you can start to line up. So let's talk about that overriding relationship very, very quickly. As you know, the stock market's been going up and up and up for a couple of years now, and now finally it's gone a little bit sideways, but overall we're very close to our highs. Let me just show you on daily charts what's going on with the currencies. So here's a daily chart of the pound US dollar. I'll blow it up. Okay. And we might even need more time. So overall, basically, here's 2010 and 2011. So for the past, basically, year, the pound has climbed against the US dollar. Okay. We have the euro here on a daily. We know that until we had this big recent excitement here overall, I'll put it back on a weekly, since a year ago, March of 2010, the euro has strengthened from 117 to 150. It's a big, big strengthening, guys. Huge, huge moves. Okay. Here's the Australian dollar. What does Australia export a lot of? Who knows? They export a lot of gold. What have gold prices done? Well, you guys understand now. Here's a relationship. Let me pop this up. Okay, here's the Australian dollar, 2008, 2009, 2010, 59 cents against the United States dollar, 109 against the United States dollar. Big move or small move? Huge move. Has it retraced much? No, it's right on its highs. If gold prices go higher, probably the Australian dollar will go higher. Again, probability, we don't know for sure, but that's been the relationship in the past. So I'm not going to go through the rest of the currencies. Actually, I'll give you one more. What does Canada export a lot of, guys and girls? What does Canada export a lot of? They export a lot of energy. All right, the U.S. dollar was 1.29. The U.S. dollar is now 95 cents, 97 cents, something like that. Big, big, huge drop against the Canadian dollar for the U.S. dollar. It's more expensive for us to go travel other places. Even though the euro had a big drop, 1.49 to 1.41, it's still more expensive than it was years ago to go, obviously, to Europe. So that's that relationship. Stock market up, and overall, the dollar has been getting weaker against these currencies. Then the stock market starts to back off a little bit, and you can see the dollar strengthen a little bit as the pound came down. The euro came down. The Aussie has kind of hung in there, basically. Like I said, maybe there's different things affecting it. So that's the whole back to basics thing. You have to understand what you're trading and what's driving it to be successful in these markets, because Everything is changing so much. We've had huge, huge, huge moves in the equity markets over the past 2 years to the upside. We gained 65% in 2009. We gained 15% in the S&P in 2010. 2011 we're up. Is it going to continue? I don't know. I don't really care as long as I'm able to understand what's going on and make money daily, weekly, monthly as a trader, protect my investments as a long-term investor. All right, let me check back and see if we have any questions coming in. What is driving the New Zealand US dollar? Good one. Okay, let's look at these both. Let's pull these both up. I'll try and kind of do one of these, and I'll move this over a little bit and bring this up, and we'll bring them up on the same time frame. So let's look at a weekly chart. Let's look at a daily chart. So there's a daily chart of the New Zealand. There's a daily chart of Australian dollar. All right. So definitely New Zealand doesn't have as much commodities for sure that Australia has as far as exporting gold and stuff like that for sure. But same parts of the world. I don't know the interest rate policy offhand as far as the overnight lending rate and interest rates in New Zealand. I know that Australia has 4.75 roughly. All right, so America, you get 0.25 on your money. Australia, you get 4.75 on your money. It doesn't take a genius to understand where you're getting better returns, right, where to put your money. So obviously we've had a huge move up, then a consolidation sideways in the Australian dollar, and then another huge move up, big move up in New Zealand dollar, consolidation sideways. Look at this, though. The New Zealand dollar has not been able to make a new high. The Australian dollar was able to make a new high and is basically on its high. Actually, let me make sure I'm looking at the right. Sorry, here we go. I thought that was off when I was looking at the prices. So let me retract that statement. So here's the Australian dollar backing off, and we'll look at gold in 1 second. Here's New Zealand dollar staying a little bit stronger and moving back up towards its high. So sorry about that. I had those reversed. So the New Zealand dollar is faring a little bit better recently than Australian dollar, but is Australian dollar tied more so to commodities? Well, let's go into Options Express and let's look at some commodities. A big one we can bring up first is oil, USO. Let's bring it up on kind of the same time frame. There's USO tracking oil prices up, and then it crashes down. Let's bring in gold because that's what the Australian dollar has a lot of down there. Let's bring up the futures. GC, we'll bring up June. GC, which is basically getting ready to go off the board anyways. But here's gold prices, up, a little bit of a hiccup, and then they climb back up. If you don't want to trade futures, you could trade the ETF that represents it, gold, and it's GLD. So up, backed off a little bit, and then kind of climbing back up to its high. And again, let me flick back to the Australian dollar. That's what the Australian dollar is doing right now. So, who's leading who? It's tough to say, but you can see that there is a rough relationship. If you're owning, I just went over this with one of my clients, if you own a lot of commodities, if you own a lot of gold, as the Australian dollar gets higher and higher and higher, what a great cheap way to go ahead and hedge your commodities or your gold that you own. It's even cheaper than going out and buying puts and things like that that are a little bit more expensive because obviously foreign currencies are leveraged a little bit more than puts than options. So stocks you have no leverage, options you have a little bit of leverage, forex you have a ton of leverage, and then you get further down the leverage line going into actual futures. So who knows which way this is going to go, but someone might have said this is, and that's hard. There wasn't a chart pattern. A lot of people like to use double tops, things like that. It was very hard to say the stock market's going to stop going up. It was very hard to say commodities are going to stop going up and falling that hard. But if you're kind of sensing that things have gone too far and starting to take the big picture into it and see how far the Australian dollar is going, see how far commodity prices have gone in some of those stocks that have doubled, tripled, quadrupled in price, see how the stock market has gone from basically 6,000 or 6,500 to almost 13,000, doubled in value in 2 years. Then you start saying unemployment hasn't changed, this and that. I know the Federal Reserve is there, but that's where you have to gauge. Someone who's young and building and putting money to IRA every single month and every single year, they may not be as worried about it. They're going to keep putting money in and have dollar cost averaging. Someone who's getting ready to start to rely on their income in their portfolio, and they're starting to pull money out and they're close to retirement, that's where they might play a little bit more defense. That's why every single person is different out there. We're all along the economy. This is what I talked about last week or 2 weeks ago on the webinar. We have health insurance. We have auto insurance. We have life insurance. Do we have portfolio insurance? Well, if unemployment gets worse, if this whole hey, low interest rates doesn't work out and we have inflation and the markets don't keep up with that inflation, or the markets start not even going down, but just stop going up and don't keep up with inflation. Lo and behold, what happens if they go down? You as an individual have to figure out how much are you at risk and what are you going to do? Do you know how to protect those assets? It's not that hard to put these relationships together. Start to use option strategies, start to use foreign currency to bring it all together and sleep better at night. Let's see. What is driving New Zealand? We got that. Is there a daily number for commodities, and where can it be found? What do you mean by daily number as far as the economic calendar? Is that what you mean? And if so, there are certain economic events basically that do track all different sectors and things like that. But more importantly, you can start to hear about commodity earnings. But more important than that, if you're a trader, you know charts. You have to know charts if you're a trader. You have to understand chart patterns, trend lines, terms I use in my classes with my students, targets and failures in sequence. And as you start to see those change, then obviously, or if you start to hear fundamental policy has started to change, like we're going to raise interest rates, well, that might obviously be bearish for things that are dollar denominated, like oil, like gold. And so you start to bring that in. So I really think that yeah, fundamentally you got to be paying attention to it, but the charts are your lifeline. I explain charts as a book. You read a page in a book, you learn information, you turn the page, you read that page, you learn more information, you turn the page. Charts, whether you're a day trader looking at a 1-minute chart, or you're a swing or intermediate trader looking at 3 weeks of data, a month of data, 3 months of data, every time it updates, you get new information to say this pattern is holding true, stay in the trade. This pattern is violating what I wanted to happen, get out of the trade. So I think the charts really are your lifeline because they're pricing in all of this data, and they tell you, hey, engage, get in the trade. Hey, exit, get out of the trade. Hey, continue to manage it, take some off the table. Maybe you move your stops, things like that. So let the charts really tell you what to do. So you might be able to expand on that, or I can expand on that because it's kind of a little bit off the topic tonight, but great question. Obviously, you have my email. You can get a hold of me if you want to go ahead and expand on that. But I'm sure digging around on the internet, that's the great thing. That's what I put there as far as resources and information, whether your broker has it, go Google it. You'll probably find it. The financial markets are so big and robust right now that anything I'm talking about, anything you're hearing about, anything you want to find, you could probably find it on your own. Obviously you have help to go find it if you need it, but you could probably be pretty savvy and go find a lot of that information out there. But very good question. But I'll go back to basically, we're chartists. We have to know the charts. That's our lifeline. Here's the New Zealand dollar trending up, 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 backing off. Well, to keep its sequence, to keep its uptrend going, it's got to make a higher high. Is it going to double top? Is it going to fail? Is it going to have a Fibonacci retracement? And, you might be able to use that and be able to sell it. So I could draw a Fibonacci retracement right on here so we can see we were here, we backed off and went down, and now we've climbed back up. We've climbed back about 76% of the way, something like that. And, you could say, hey, that's come too far. I might choose to be bearish here because the New Zealand dollar is kind of, running with commodity prices, things like that, and I could use it to hedge all different kinds of relationships. But the bottom line is you use the charts to tell you where to go, to tell you where you're getting out for a loss. You don't do anything blindly, basically, is what I'm getting at. That's the whole point behind that disclaimer. If you do something without a plan, you won't be able to react if it goes against you, and that's where you can really damage your account. So it was a good segue, I guess. Let's see. Is there a daily number for, let's see, Canada? What does New Zealand have to offer? Canada is oil, Australia is gold. What about New Zealand? Sheep. New Zealand has lots and lots of sheep. I don't know. That's what I was saying is obviously Australia, the Australian dollar fell off a lot more than the New Zealand dollar, maybe because it was more closely tied to that fall in commodity prices. I'm not sure. The New Zealand dollar, I think we would have to go look at their interest rate policies and look a bit closer and see that kind of stuff. And like I said, that's the whole back to basics. Look at your entity, and if you're trading the New Zealand U.S. dollar, know it very, very well what's going on between U.S. dollar policy and New Zealand dollar policy and try and find out. But no, aside from having more sheep than people, I don't really know what they have. Lots of commodities. I know they have lots of fruit and things like that. Okay, interest rate. Yeah, I would definitely look at interest rates. So thank you for plugging that question in. How do you remove the Fibonacci line to reset it? Again, we're getting a little bit off topic. I'll do it quickly, but everything is right-click here on Interbank FX. So if I right-click, it brings up this window. I drew a object. So a Fibonacci is considered an object here in Interbank FX. So I right-click, I go to my objects list, it brings up Fibonacci. I go ahead and click on it. I want to delete it, and it is gone. So right-click, and then you'll find it under indicators or objects, depending on what you drew, what you had on. Indicators would probably be more like your moving averages, things like that. Objects are trend lines and pitchforks and things like that. So all depends, but everything is right-click, and you should be able to find it. Again, that's the whole point behind this, is Interbank FX is here to help you. They want to engage with you, whether it's chat, whether it's a phone number. Get a hold of them and ask them these questions. Don't let these little questions get in the way of you guys making trades. That's the last thing you want to do. You've got to focus on the markets, what's driving them, making good trading opportunities with good trading plans, and doing the best you can. All this other stuff is like small little hiccups that you can get over very, very, very easily. I don't go over too much of that stuff. I want to teach people how to trade and invest and make money, so I leave that kind of work for my clients to go and find out. I'm not going to try and charge them to go over that type of information, obviously, because that'd be silly. It's there for free. You gave your money to Interbank FX. They're very, very, very happy to help you out. That's what they want to do. They want to be there, and they're known for their customer service. So please rely on that, you guys. All right. So getting again back into the whole, I think we've been able to get back to here at the average trading range. So let me get back to the slides here. So basically, the average trading range, ATR, why is it so important? Because we know that if the average trading ranges pick up, like we saw in the euro there when we had 400 pips in a day versus 100 pips in a day, we know that there's more volatility, there's more movement, and I'm going to show you that in an intraday chart in just a moment. Traders love fear and uncertainty. Investors don't, but if we're investors and we're smart, we can protect that if we understand volatility is picking up and things like that. We could buy calls on the VIX. We could buy puts on the stock market, whatever we want to do. But you and I as traders intraday need movement. So the average trading range of the VIX, you could go and see, is the VIX picking up, basically. I showed you that chart. So you can go to your Options Express or whatever broker you're using for the stock market and options and things like that, or you could Google it and find out if the VIX is picking up. And then understanding various types of markets and how it affects us. So there are low volatile markets where the ranges are going to be smaller, and we may use different types of trading strategies and support and resistance and things like that. And then high volatility. And so the one thing I want you to remember is when you have a 400 pip day versus a 150 pip day, you have to expand out where you're trying to get in, because things are happening so much faster that if you're a very short-term trader trading for 10, 15, 20, 25 pips, you may have to trade now and risk 20 or 30 or 40 pips, but you still risk the same amount of money by cutting your size. So if I trade 10 contracts and risk 10 pips and I lose that, $1,000, whatever it is, well, I might choose to risk 20 pips and trade 5 contracts. So I'm risking the same amount, but I'm giving it a wider berth because I understand that it's moving more. That spreads might be widening out because there's so much news going on. I need to let it breathe a little bit more. I kind of talk about it as a rubber band. That rubber band stretches, comes back together, stretches, comes back together. You inhale, you exhale. Well, the markets are just taking bigger inhales and bigger exhales. They're all excited. They're in this big fury, of anger and excitement, and that's great for us, but we've got to know how to approach it. So you've kind of got to widen out your parameters for saying, here's where I usually get in. I might have to give it a little bit wider berth, or I might put my contingent order a little bit below or above further where I usually do it, just to give it a little bit more breathing room. So just make sure you're understanding as the markets ebb and flow and breathe in and out and exhale in and out, that you're adjusting your trading size, your account risk, not necessarily your account risk, but your trade risk, accounting for busier and busier markets. So we'll get back to this in just a moment. Let me just see if there's any questions. Okay, so let me just get to my final point and show you. And I'm going to start here with the S&P on just a very short-term chart. I want to show you what happened yesterday with all of this movement. So let me bring this down and go to just a 3-day chart and a 3-minute. So yesterday, the S&P was basically started up, and it started up. And you know what? I actually might even do this on the Dow Jones to make it easier for you guys to see the points. So the markets closed on Monday around 12,380. They opened up on Tuesday around 12,423. So that's about a 45 pip move to the upside, basically. And then they went crashing down from 12,400 down, a little bit of a hiccup here, and then down again, and we bottomed out around 12,350. So we lost about 80 points. So up 50, down 80. That's 130 points of movement. And then we climbed back up towards the end of the day, up about 50 points. So up 50, down 80, up 50. So that intraday volatility was very good. So just kind of take a mental image of that chart. And this is actually what I put on my blog yesterday, and I put on the Daily Forex Trading Edge. You guys might be getting information from it. A lot of you follow Raggi and her great information that she provides in her daily trading edges and webinars. Well, they're posting a lot of that now to Daily Forex Trading Edge, and I'll give you that link in just a moment when we get there. But I wrote a chart. I wrote a little article about matchmaker between the S&P and the Euro US dollar. So here we are. The stock market goes up, crashes down, and then climbs back up. All right, now let's go to look at, and let me just resize these. Stick with me for just 1 second. Uh-oh. I think I just closed down our euro by mistake. I clicked on the wrong one. Okay, bear with me as I bring back up the euro here. Let's see, euro US dollar. All right, and now it's going to be all messed up because it's not how I have my charts. So I got too excited there to show you my point and clicked on it to close it. So let's look at a 30-minute chart, and let's find, let me resize this, bear with me. Like I said, sorry, I just closed out my chart and I didn't want to do that. All right, so let me try and do this so you guys can see it. Okay, so here is, let's see, the 24th of May, so that was yesterday. So here we have, let's find basically the trading time frame for the stock market. So right here is where the stock market opened up, roughly, and the euro goes up a little bit. Stock market crashes down, euro crashes down. Stock market starts to recover late in the day, basically, kind of right in this, actually, let's see if I can even find it. Am I on the right time frame? I'm sorry because I'm looking at all these new colors and things like that. So yeah, this is GMT time. So it's much smaller here basically, but this is the move. Is the euro kind of tracked the stock market performance, and it moved and had ebbs and flows just like the stock market had ebbs and flows. So stock market opened up, euro went down, and let me see if I can even get this on. Here it goes. It makes more sense here if this is the 24th. So stock market opens up and goes up, stock market crashes, euro crashes, stock market rallies back up towards the end of the day, and the euro rallies back up. So this move right here is very, very similar to the S&P move that I was showing you. So that's what I mean by understanding these intermarket relationships, all right, is they're working sometimes they're not. We still have to have trading plans. We still have to have risk reward. We still have to trade the right amount for our account size, depending on if we're a long-term trader or short-term trader. We have to understand that account risk and trade risk balance, basically. But there are some fun relationships out there that we can take advantage of, and that's what I'm talking about, is on the bigger picture, you who are long the economy with jobs and assets and homes and things like that. Hey, if you're getting close to cutting back on that job or whatever it is, or you're worried about losing your job or your salary has been cut back, how do you start to defend your positions that you'd like to still increase in value, but they've increased so much, is there a guarantee they're going to continue to increase? We don't know. If there's a QE3 and a QE4 and a QE5, great. Everything's going to continue to increase, I guess, based on past performance, but there aren't any guarantees out there. So looks like that's it for the questions. I will wrap up here. Let me throw back up here these slides. So let's just do a quick review. We talked about fundamental events. I'll do that 2-week catch-up for sure. You'll be able to get that on my blog most daily on a daily basis, so make sure you check in there. We talked about technical analysis, looking at major trends and going on in the relationship between fundamental and technical analysis, and then definitely went into intermarket relationships, and then talked about what volatility means for us as traders. What does it mean for us for entering and exiting, depending on what type of trader we are, understanding that more volatile markets might cause us to kind of, adjust our trade risk and things like that. But the bottom line is we want volatility. Not really good for the most part for investors, because if volatility is going up, usually the VIX is going up, which means the stock market is going down. but that can make for fun opportunities for us. Next webinar, 2 weeks, June 8th at 9 o'clock Eastern. Again, we'll review that fundamental analysis. We'll cover technical analysis, what's going on in the markets. And then, like I said, I'll cover in detail. I'm going to take out this word limit while you're looking at it right now. I missed that one. It basically is a contingent order because it's basically saying I want to get filled at this price. And when that price gets hit, it turns into a market order. So there's no guarantees. So I just want to make sure that you're not, not using the term limit. You're using almost a contingent or pending order that will turn into a market order. If that market order, then that pending and market order get filled, then basically we have automatically preset our stop loss and take profit. So that's a great one to use with Interbank FX is you can set up an order to say, I'm willing to get in at this price, roughly, and then I will get filled if the markets come into that area. Basically, I'll get filled at a price, not guaranteed to be a specific price, but close to it, hopefully, depending on the speed of the markets. And then if that gets filled, automatically, boom, my stop loss goes in, boom, my take profit goes in. Now I can start to watch the charts evolve over the next few minutes, over the next few hours, next few days, whatever my trading time frame is, and then I can adjust it as the markets, like I said, as you turn a page in the book, as the charts update, you start to basically be able to massage or manage the trade, as I call it, and you could say, hey, I want to take some off the table and play with house money. Now I have a winner, or I want to move up my stop, or I want to turn my stop into a trailing stop, whatever it may be. There's so many different ways to do it, but the point is, bare bones, at least you have a pending order to be filled, and if it gets filled, you have a stop loss to get out for a loss and a profit area to get out for a profit. Education and recordings, go to ibfx.com and then their education site. Again, the new site that they're pushing a lot of you to that, like I said, has Raggy's great information and commentary on it, as well as mine, is the Daily Forex Trading Edge. And then you can find these videos on the YouTube site right here. And then again, I post everything to my blog, financebanter.com, and then the category is Forex. But again, a lot of that same information will end up here on that Daily Forex Trading Edge. So I'll let you take a quick look at that and get those sites. But this is the blog. I have Bloomberg here. I talked about Bloomberg, so that's the great website there. And then this is my blog, the Forex website, the Forex section of Finance Banter right there, where I put in a couple articles. So there's the article right there about the locals take, and then matchmaker, SPY, and Euro US dollar. So I had a couple good articles. But like I said, it is all showing up as well for the most part on Daily Forex Trading Edge, so you can find it there. So let me just check if there's any last minute questions. You guys know how to get a hold of me. Let me just flip back to the front here. So you have my name. If some of you are new to my webinar series, there's my name, there's my email. You know how to get a hold of me. Thank you very, very much for your time tonight, and I look forward to speaking with you in 2 weeks and engaging and interacting with you through the blog and things like that and the articles in the meantime. Thank you very much.